Thanks for clicking. The household debt of Canadians is almost $3 trillion. This according to a new report from Stats Canada.
Those are rookie numbers in this racket.
Indeed, and to the surprise of no one, media attention towards the growing debt of Canadians is scant, instead focusing on the very real possibility that this could go on forever without consequence. Yet, cracks are beginning to form, and the credit rating agencies are starting to raise concerns over the amount of debt held by Canadians, especially amid a weakening economy. And, luckily for us, we don't have to rely on the media or common sense to tell us why this is a problem, as we not only have the data from Stats Canada, but also a multitude of research.
The is that?
So what I want to do today is go over the data from Stats Canada, take a look at the credit agencies raising the alarm bells, have a look at the research and the history to show us why this is a problem, and then go over some implications for the future. The amount of debt held by Canadians, as we'll see today, could very well prove to be an ongoing, self-perpetuating problem. We will continue to cover it on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. As mentioned, the total household debt now held by Canadians is reaching close to $3 trillion, now sitting at $2.923 trillion. And, unsurprisingly, a large portion of that debt is held in mortgages, now sitting at $2.17 trillion, up almost 27% since the beginning of the pandemic. And I know what you're thinking, it's all the free money, though it's not just that, though I suspect that was the original cost. As mortgage debt continued to rise, even after the Bank of Canada started raising rates in February of 2022, up 10% in a little over 2 years.
I have abilities.
But so what? $3 trillion in household debt, $2.2 trillion of that is sitting in mortgages. So what? Well, it's a lot, considering that Canada's gross domestic product, its GDP, was sitting at $2.2 trillion as of January, which translates into a household debt to GDP ratio of 132%.
Yeah, it's a crummy system, but what are you going to do? Oh no.
That's over 30% higher than the United States was at the height of the financial crisis, and much higher than the 110 or so that Canada was sitting at in 2022, when our household debt to GDP was 4th in the world. And all of this debt is fine, I suppose, so long as Canadians are making their payments. However, Moody's credit rating agency is expressing unease about the short-run outlook for loan performance. While loan delinquencies are rising, though remain relatively low amid a relatively strong economy, Moody's is warning that if Canadian households were to lose this crucial support, as the March jobs number hinted, default rates would quickly accelerate higher. So, while delinquencies are still relatively low were the economy to shift, we could see those numbers pop up high and quickly.
That's never happened before.
And we can already see some signs of growing stress, with Equifax noting last month that mortgage delinquency rates have surpassed pre-pandemic levels in Ontario and in BC. And it's not just mortgage loans that are seeing the increase in delinquency rates, with the number of auto loans past due 60, 90, and 120 days, all up over pre-pandemic levels, with Equifax noting the budgets have hit the limit for some. So, household debt nearing $3 trillion, household debt to GDP hitting over 130%, higher than the US had at the height of the financial crisis, and delinquencies are rising. Now we know the magnitude of the problem. What's the solution?
We'll dig our way out.
One solution is indeed to grow our way out, grow the economy to such an extent that households have more income in order to pay back that debt. With that said, a study from the Bank of International Settlements found that household debt accumulation tends to provide a drag on growth, meaning that as households pay more and more of their disposable income towards debt, less and less goes towards the economy, providing an ultimate drag on the GDP. The study found that those GDP dragging effects tend to be more pronounced, tend to get even stronger, once the household debt to GDP level hits 80%. And the problem with the growing level of debt is that it snowballs, in that if policymakers want to stimulate the economy, want to help grow us out of this problem, it takes more and more fiscal stimulus to jumpstart that economy. With the Federal Reserve finding that once household debt to GDP reaches 70%, policymakers are likely to face non-trivial, real costs in stimulating the economy through credit expansion. Under normal times, if governments want to stimulate growth, they spend money, put money into the pockets of Canadians. Canadians spend it, put money into the economy, and we see the economy grow. However, if debt levels get too high, then a large portion of that stimulus merely goes back to paying other debts. That money doesn't end up in the real economy, rather ending up in the accounts of the banks.
What are you going to do?
And it's not just the BIS and the Fed finding that high household debt provides a drag on the GDP, with Brookings finding something similar in a 2023 study, as did the National Bureau of Economic Research.
Research is what they're calling it.
So the idea of Canada growing its way out of this debt problem is not exactly in the cards. So what about lowering interest rates, make that cost of borrowing much easier, and jumpstarting the economy, which could make it easier to pay back that debt? Well, a study from the European Central Bank found that for every 1% decrease in interest rates, borrowing increases by 7%. So lowering interest rates may delay the problem, but it won't fix it. In fact, it will probably magnify it. Further, even if lowering interest rates would help, as we've talked about so many times on this channel, the Federal Reserve looks like it's going to be staying higher for longer, with even some voices saying that the Fed could be raising rates, so it's not like Canada has a whole lot of room to lower interest rates to make that debt more manageable. With that said, the major increases in debt that Canada has seen really shouldn't even be happening, with the Federal Reserve finding that when central banks increase rates, households tend to respond by borrowing less and repaying more. But that's not what we're seeing in Canada. From February of 2022 until now, households didn't repay their debt. In fact, debts rose by 8% over the past 2 years. So the idea that Canada can either A, grow its way out of its debt, or B, lower interest rates to make those debts more manageable, aren't likely in the offing. Add to that is the growing productivity problem as cited by the Bank of Canada, which makes any attempt to grow our way out of our debts even more unmanageable. In fact, it's entirely possible that the run-up in debt that we've seen over the past few years is due to another phenomenon cited by the Federal Reserve, where lower cash flows brought on by higher interest rates actually causes people to borrow more to offset those lower cash flows. So, with rates higher, with the cost of servicing debt higher, Canadians take out more money to service that debt. It's like taking out a new credit card to pay off old credit cards.
You do whatever you have to.
And there is some evidence to support this argument, with credit card balances growing 25% since the beginning of the rate hikes in February of 2022. And we obviously don't need a study to see why this is a problem. It's like a snake eating its own tail. Eventually, the creditor is going to realize they're never going to get paid back and pull any new credit. So, despite all of the rate hikes, or maybe even because of them, Canadians continue to pile on the debt, now inching very close to $3 trillion in household debt. Canadians are inching ever so closely to $3 trillion in debt. Our household debt to GDP is one of the highest in the world, now over 130%, and we have the media pushing the narrative that the average home in Toronto could reach $2 million, pushing the idea that this could go on forever without consequence. Why stop at 2? Why not go 3, 4, $5 million?
Completely normal.
And the reason, of course, is that it can't go on forever. There are economic fundamentals at work which have never, not once, enabled anyone, any nation, any person, the ability to continue to pile on debt forever without consequence. Remember when the real estate industry said that money was free and would be forever? They're now telling you that real estate prices can go up forever without any problems. Yet, as the United States learned in 2008 and subsequently underwent a deleveraging cycle thereafter, that is simply not the case. I'm not sure what the solution to this is, but I can say for sure that digging our way out, adding on more debt without corresponding economic growth, is definitely not one of them. And the debt that we've already piled on, the 130% household debt to GDP, the studies show, is going to become a major drag on our overall economic growth. It's going to be a major drag on any attempts that we make to grow our way out of this problem. With that said, we will continue to track the household debt of Canadians and the effects of that debt on the Canadian economy on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.